Advice 2. Dancing with market laws. When the market supply and demand are imbalanced, we adjust our supply accordingly. If there's excess supply, we strategically withdraw from competition. However, it's essential to note that we don't follow this strategy merely for stability. Rather, we believe it's the most advantageous approach for business operations. You might be familiar with the legend of the Tulip Mania. In the 17th century, certain tulip varieties were considered the most expensive and rare flowers in Europe and even globally. The story goes that an Austrian envoy stationed in Turkey encountered brilliantly colored tulips by chance. Captivated by their beauty, he brought some bulbs back to Vienna. Later, a Dutch florist in the Austrian court also introduced them to the Netherlands. The exquisite tulips, with their vibrant colors and elegant allure, drove the Dutch population into a frenzy. The wealthy and powerful dispatched agents to Turkey to purchase tulips at exorbitant prices. The entire country became obsessed with tulips, considering them a symbol of nobility and sophistication. In 1635, due to the scarcity of priced tulip bulbs and speculative trading, prices skyrocketed by several-fold. At one point, the price of a single tulip exceeded that of gold. In 1635, tulip speculation reached its peak, with some bulbs fetching as much as £10,000, an astronomical sum. Banks and stock exchanges in major cities displayed daily tulip prices. Strangely, tulip prices only rose, never fell, leading Europe's wealthiest individuals to engage in frenzied buying and selling. People sold their properties to acquire tulips, and in Amsterdam, a house was priced at 3 tulip bulbs. Each new tulip variety cultivated by flower farmers became a substantial fortune. Even a single tulip bulb could be exchanged for 4 fat cows, 8 robust pigs, 12 plump sheep, 4 tons of wheat, 8 tons of rye, 2 large barrels of fine wine, 2 barrels of beer, 2 barrels of butter, 1,000 pounds of cheese, a set of high-quality clothing, a large bed with all its bedding, and a silver-footed goblet. However, in 1636, due to increased supply, tulip prices plummeted. By January 1637, the Dutch tulip market had turned into a chaotic gambling den for speculators, resulting in widespread bankruptcy within months. This tale underscores a fundamental market principle. Stock market fluctuations depend on the relative strength of buyers and sellers. When demand exceeds supply, prices rise. When supply surpasses demand, prices fall. It's crucial not to defy this market law, otherwise, you may face your own tulip catastrophe. For the entire stock market, if most stocks are in short supply, the stock price index will rise. Conversely, if most stocks are oversupplied, the index will decline. The factors influencing stock market supply and demand are undoubtedly complex and challenging to grasp. Hence, theories like the stock market unpredictability theory or arbitrary stock price movements exist. However, from a social psychology perspective, understanding stock market supply and demand seems deceptively straightforward. If most investors and speculators believe the market will rise, buying stocks for profit, demand will exceed supply, leading to market growth. Conversely, if investors anticipate a market decline, selling stocks to avoid losses, supply will outstrip demand, causing the market to fall. In summary, the stock market adheres to certain rules. Remember, the market dances to its own rhythm. Section 1. The Invincible Treasure. Perhaps you often complain, why do I always buy near the market's peak and sell near the bottom? Why am I the one consistently losing money? The truth is, when speculative traders follow the crowd buying when others buy and selling when others sell, they often miss the optimal entry and exit points. Their collective behavior creates peaks and valleys, at least in the short term. The consequences of this poor herd mentality are predictable. Rare things are precious. This is a fundamental market law. When supply exceeds demand, wise decisions involve temporarily stepping back. Conversely, when supply falls short of demand, it's the perfect time to enter. In the stock market, what everyone favors isn't necessarily the best choice. Blindly following others is a recipe for failure. From this, We should understand what we should and shouldn't do, and when to refrain from acting. The market operates by certain rules. However, as we mentioned earlier, the stock market's behavior resembles Brownian motion in physics, chaotic and unpredictable. So how do we discover the market's underlying patterns? Does the stock market have rules? Whether it's the personal expectations of investors or the research interests of stock market theorists, uncovering the stock market's inherent rules has always been a relentless pursuit, sometimes with calm determination, sometimes with fervor. Almost everyone holds an unshakable belief: everything follows rules. Even if some rules remain undiscovered, they will inevitably be revealed in the future. Indeed, for many, the idea that the stock market lacks rules would disrupt the order, turning it into a colossal gambling enterprise. Since the stock market's inception, people have continuously claimed to predict its direction. Related books abound, yet unfortunately, people haven't reaped significant benefits. The stock market remains a simple enigma. It either rises or falls. It lacks predictability. The stock market defies reason. It's inherently unpredictable. No one, whether an individual, a technology, software, or government, can consistently predict or exploit this complex interplay of countless factors. But does this mean the stock market lacks any discernible patterns? Is it purely chaotic? If so, why do some consistently profit, like Warren Buffett, whose failure rate is minimal, while those unfamiliar with the stock market consistently lose? If the stock market were genuinely chaotic and capricious, shouldn't Buffett's wins and losses be more evenly balanced? Amidst the volatility, there's an underlying constancy. Regardless of how complex and elusive the short-term factors affecting the stock market may be, the primary determinant of long-term trends is intrinsic value. Thus, short-term stock market movements are influenced by supply and demand, appearing erratic. However, through analysis of intrinsic value, long-term patterns emerge as an internal regularity. Where does the stock market's regularity lie? The term regularity refers to the inherent connections in the movement of phenomena, a necessity independent of human will. The stock market adheres to such regularities. However, if stock market rules were as straightforward as water flows downhill, only individuals with zero intelligence would lose money. Stock market rules have unique characteristics, influenced by various factors: economic, policy-related, and the interplay between retail and institutional investors. Despite the ever-changing nature of the stock market, certain themes persist. Short-term volatility remains hard to predict, but underlying regularities exist. The primary factor affecting trends isn't overly complex. It's the stock market's intrinsic value. Therefore, grasp the essence, make informed judgments based on experience, and while you can't predict stock market changes with absolute certainty, you can still navigate the overall trend. Some argue that if they discover stock market rules through rigorous research, they can secretly enjoy financial gains. But consider this: if these rules can't be shared with others without losing their universal effectiveness, can we truly call them objective rules? So yes, the stock market has rules, but not everyone can perceive or fully understand them. Remember, the stock market is ever-changing. Even if you understand its rules, it doesn't guarantee profits in every trade. Think of it this way: we all know that flipping a coin has a 50% chance of landing heads, but whether the next flip results in heads or tails remains known only to a higher power. So don't rely solely on stock market rules to bring wealth automatically. But then again, someone who doesn't even know the 50% probability of a coin landing heads is in a worse predicament. On the other hand, assessing a stock's intrinsic value isn't straightforward. Understanding stock market rules, a complex journey. As mentioned earlier, stock market rules aren't as straightforward as we might imagine. Knowing the rules doesn't automatically guarantee profits. While everything follows certain patterns, these rules come with prerequisites and are not immutable. The unique nature of stock market rules makes their direct application challenging. If there were a formula to precisely calculate a stock's intrinsic value, the stock market wouldn't hold the allure it does. But alas, it remains an intricate puzzle. So, How can we embark on the journey to understand stock market rules? How can we find that elusive edge for profitable investing? The wisdom of market sages, intuition and artistry. In reality, seasoned market participants possess unique insights into market rules, but their wisdom often eludes ordinary investors. Some say, conquer yourself to conquer the market. Others emphasize the importance of maintaining a positive mindset for better returns. Investing is often described as both science and art. But how do these aphorisms apply to stock market investing? While they sound profound, their practical utility can be elusive. The stock market defies easy quantification. It's not a binary system. Even investment gurus occasionally speak in riddles. George Soros, investing in the stock market requires intuition, imagination, and a critical mindset. Peter Lynch, company CEOs can be deceivers, and you might not see it. Can you sense it? Perhaps you can. Perhaps not. This requires intuition. John Templeton, the best fund managers possess a sixth sense for stock trends. It's an art, not a science. You sense that a particular stock has all the right elements, and you know its price is about to change. It took me 5 years to cultivate this feeling. David Shaw, who uses advanced mathematics and powerful computers for trading, acknowledges that intuition and instinct play a crucial role. He says, surprisingly, during our initial work, this way of thinking, instinct and intuition, was more critical for us. It's what led us to hypotheses and testing. It's definitely not a mechanical process. Buffett's insights, the special trait for stock market success. Warren Buffett, the Oracle of Omaha, offers valuable wisdom. The essential condition for making money in the stock market is a special money-making temperament, not necessarily extraordinary intelligence. Shrewdness doesn't always equate to profits. He cites historical examples. Sir Isaac Newton, who discovered universal gravitation, initially thrived in the stock market but later suffered significant losses due to greed. Newton's famous quote captures it: "I can calculate the motion of heavenly bodies, but not the madness of people." Buffett further illustrates this point with a contemporary example. Two Wall Street recognized investment geniuses who lost over $6 billion in speculative derivatives trading last year. His conclusion: making money in the stock market requires that special temperament. So, how do we interpret these seemingly important yet seemingly useless words? First, the wisdom of the masters holds true. They indeed know how to profit in the stock market. Perhaps they'd like to share their secrets, but the truth is, they can't articulate them precisely. In the words of Zhuangzi, great use is useless. To grasp the profound utility of the seemingly useless, we must immerse ourselves in the stock market. The invincible treasure. What is it? But what about the so-called invincible treasure? Is it an unchanging law or a predefined formula? If it were that simple, the stock market would be everyone's personal ATM, not the enigmatic beast that keeps investors on their toes. The stock market's volatility, complexity, and the unique nature of its rules prevent us from directly applying them to guide our investments. So, is there no effective method for success? The answer is no. While we can't precisely state stock market rules, we can observe phenomena. Just as noticing a river flowing downhill suggests lower terrain ahead, understanding stock market regularities and keenly observing market changes can lead us to some conclusions. The key to invincibility. Here are some principles to consider. Go with the flow. Following market trends leads to prosperity. Going against them leads to ruin. Even amidst change, there's consistency. As the Tao Te Ching compares it to water, remember that water flows downward. This fundamental principle helps us understand all water movements. Avoid blindly following the herd. Market trends affect supply and demand. Blindly following the crowd can be costly. Reject the chaos fallacy. While stock market appearances seem chaotic, there are underlying rules. Avoid dogmatically applying strategies. Context matters. In easy markets, rigid strategies lead to failure. In summary, the stock market follows certain rules, and utilizing these rules requires a trained intuition. This intuition is honed through experience, time, keen observation, and insight. However, don't fall into the trap of believing that finding a single indicator or software solution guarantees effortless success. There's no shortcut to perpetual gains. It's a daydream. The birth of investment masters. Warren Buffett once said, "The essential quality for making money in the stock market is a special money-making temperament, not necessarily extraordinary intelligence." But what exactly is this special temperament, and how can we cultivate it to become investment masters? Let's explore 4 essential steps. Understanding. First and foremost, grasp the rules of the stock market. Don't be misled by its chaotic surface. Recognize that while the market is ever-changing, it also follows certain patterns. Understanding short-term fluctuations is not enough. Focus on the long-term trends driven by intrinsic value. This is the foundation of knowing the facts. Action. Like standing alone on a high tower, surveying the vast horizon, the journey in the stock market can be arduous. Long-term commitment is essential. Theories must be tested through practical experience. Buffett's investment principles crystallized from relentless practice in the market. Thus, practical application is indispensable. This step is about acting accordingly. Enlightenment. Just as a belt gradually widens without regret, our understanding of market regularities deepens over time. It's a lengthy process, but the insights gained are worth the effort. When you grasp the why behind market behavior, you've achieved enlightenment. This step is about knowing the reasons. Attainment. After going through the above 3 steps, you ascend to investment mastery. It's like searching for someone in a crowd after countless attempts. You suddenly find them in the dim light. Combining knowledge and action leads to true mastery. This step is about attaining the way. Remember, the fusion of knowing and doing ultimately leads to mastery. Our goal is to understand the market's underlying rules deeply. Market laws aren't simple phrases on paper. They require genuine comprehension. Trust your intuition is an inner logic that guides you, even when you can't put it into words. The path outlined above trains this intuitive ability. Breaking conventions. The power of contrarian thinking. Market rules tell us not to blindly follow the crowd. Sometimes, when everyone else is chasing, it's the right moment to exit. This is the essence of contrarian thinking. In the year 2000, the dot-com bubble swept the global stock markets. High-tech internet stocks soared, even those with massive losses and sky-high price-to-earnings ratios. But Buffett remained unfazed, claiming he didn't understand technology well enough to invest. A year later, the dot-com bubble burst, revealing that not just high-tech was merely his excuse for not following the herd. Accumulating wealth requires breaking away from conventional patterns. Avoid popular stocks in hot industries. Instead, seek out overlooked companies in sectors that seem stagnant. Be the outlier, the one who ventures where others don't. This unconventional approach often leads to victory. Consider the story of Lila, a farmer-turned-gold prospector during the California gold rush. While most struggled to find gold, Lila had a different idea. Instead of digging for gold, he used his limited funds to create durable clothing. When other prospectors faced hardship, Lila sold his sturdy clothes at affordable prices. Soon, everyone wanted them. Lila's unconventional approach earned him substantial wealth. Remember, while pursuing your main goal, seize opportunities that beckon from unexpected directions. Don't fixate solely on the path ahead, observe the scenery along the way. Keep your eyes open and ears attuned to all directions. Don't rush to follow the crowd. Practical insights. Buffett's famous quote captures it well. We will have fear and greed, but when others are greedy, we should be fearful, and when others are fearful, we should be greedy. In 2005, during Berkshire Hathaway's annual shareholder meeting, Buffett shared insights on market highs, the U.S. real estate bubble, and the dollar's trajectory. He warned of the real estate bubble, especially in California and Washington suburbs. He remained bearish on the dollar, despite its recent rebound. His investment focus shifted to index funds, emphasizing their low costs and long-term profitability. Buffett's three fears for individual investors. Fear of high costs, frequent trading, and excessive management fees erode returns. Fear of rumors and gossip, base investment decisions on rational evaluation, not hearsay. Fear of timing, often, investors enter or exit too late. Timing matters. Remember, supply and demand govern market economics. Going against these principles invites market punishment. Buffett's success lies in aligning with market trends. Following the flow leads to victory. Keep this wisdom in mind as you navigate the investment world.